So roughly 70% of businesses that go to market that are actively trying to sell never actually do sell. And there's a lot of reasons why, but in my experience, I'm a business broker. I help business owners sell their business. And what I've seen, the common reasons for why a business doesn't sell really boils down to just a handful of things. And I want to touch on really the top three that I see. And the first one being is the owner dependency, right? And this is a very common thing, especially in the small business space where the business owner is obviously involved in the business. And that's going to be the case for many businesses. But the real big thing that you want to focus on here is how involved is the owner or ownership in revenue generating operations. And you really just have to look at it from a buyer's point of view, because what they're trying to figure out is, yes, they're going to take a look at the numbers and the financials are very important, but they're trying to figure out, when I remove the ownership from this business, what happens to the business? What happens to revenue? What happens to customers? What happens to potential vendors? What happens to the employees, right? And so they're trying to figure out, how dependent is this business on the owner being there? Or if we remove the owner, are things going to be okay? And then can I step in and things are going to move consistently as they have, right? So they're really trying to figure out, how big of the shoes do I need to fill as the buyer in this business? And of course, the owner and ownership play very important roles, but really they're looking at the revenue generating operations. Are they solely responsible for bringing in a ton of revenue for the business? Because again, when you pull them out of the equation, that means you're going to lose a lot of revenue. So the owner dependency tends to be a major reason for why businesses don't sell. And I've seen deals where the numbers are great. The profit's there. It's very consistent. It's growing at a conservative rate every single year, but the owner is out on job sites, or the owner has all the relationships with specific customers that are really big customers, and they only want to do business with that specific person, right? So getting yourself out of operations as much as you can is going to be extremely, extremely beneficial. And sitting on this side of the video saying that is a lot easier than actually implementing that, but it can really be the difference between selling your business and just not selling your business at all. And I have recently just turned down working with a business because of that reason. There was way too much owner dependency across 3 owners, and it just meant that the buyer was then going to have to fill 3 operational roles day one. So the best piece of advice I can give in that situation is put all of your focus and attention on building up some sort of management team, or delegating more of the operational side of things to a key employee, a general manager, right? Trying to hire from within and building that up, or hire from outside and build up an actual management team to run the business. Now, I'm not saying ownership doesn't have to be involved in the business, right? But focusing more on business development or the back end systems of the business, just not going out and earning the dollar for the day. That's when things become difficult, because then the buyer has to go do that. And, unfortunately, not a lot of buyers out there are looking to go buy a job. They're looking for an investment to work on the development side of the business, the growth of the business, systems in the business. And so if that's your role, a buyer's going to be very eager to then step into your shoes and focus on that role as well. So owner dependency tends to be one of the number one reasons why good businesses, profitable businesses, don't sell. And as you can imagine, that's the case for a lot of small businesses. The owners are heavily involved in operations, and that is why 70% of businesses that are actively trying to sell or actively listed on Biz Buy Sell or on the market just don't sell. There's too much owner dependency. The second one is pricing, price expectations. Now, you hear this a lot, and I'm not going to say it's all the sellers saying that they want way more than what the market is going to pay for the business, because I would say it's a mix of sellers' expectations on the price, but also broker possibly mispricing the business. And why that happens could be a variety of reasons. It could be a broker wanting to just add more listings to beef up their resume, and they're overinflating the price to get someone to sign a contract. So it never hurts to get a couple different opinions from different brokers to get the accurate price or get a good range. And then also yourself, just having the correct price expectations, because it's just like anything else. It's worth what the market is going to pay for. Now, there's equations and valuation formulas to determine a specific price range that you can expect from the market, maybe a lower end if you want cash up front, a middle end, or maybe a higher end that would come with a little bit more structure, meaning a smaller seller note or some contingencies put into the purchase agreement. But you should have a good idea of the price range that you can expect from the market. I totally understand why this happens though, because you put in 5, 10, 15, 20, 25 plus years of blood, sweat, and tears into this business. You want to get paid for it. And that's the brutal side of things when a business owner doesn't do proper exit planning, that they then hit the wall one day or they get burnt out and they say, I'm ready to sell, let's go sell this thing. And their price expectations just aren't aligned with what the market is going to pay for it, when you can do proper planning to get to that price that you actually want. Owner dependency being one. If you can build up that management team, it will help the asking price on your business. But that, again, is a major reason why businesses don't sell. And you can go to Biz Buy Sell and look at some listings for sale in your area, and then go check it again in 4 months, 5 months, and a lot of those businesses will still be there. And one of the big reasons is just because the price is too high, unfortunately. Because in a lot of cases, especially again in the small business space, meaning if the business sale price is $5 million or less, the majority of the time the buyer is going to use an SBA loan to buy that business. And so it has to fit in the bank's box of approval, right? They're not going to give more money than what the business can service that debt on. They're going to make sure it fits in a tight box. And so you can't overlend a buyer where they're not going to be able to pay back their loan from the cash flow of the business. And I think that's what you see a lot of times on these listing platforms, is the asking price is more than what is even feasible for the bank. And so you're basically telling the buyer that they have to pay, maybe 50% of the asking price out of their pocket in cash. And it's a difficult ask, and it just slims down your buyer pool. So price expectations on both the broker side and the seller side is another major reason why businesses don't sell. And then lastly, I would just say, again, from my experience, is any high risk issues, any risk that's perceived from the buyer's shoes in the business or in your business. And that could be anything like high customer concentration, which means you could have $1 million in revenue, but $600,000 of that revenue is coming from one customer or one client of yours, right? And you could say it's a really good client, it's a loyal client, we've been with them for 10 years, but that's 60% of your revenue coming from one client or one customer. And if I'm the buyer and I buy your business and that customer or client decides to stop working with the business, I immediately lose $600,000 in revenue. That is a major risk factor, and there's a lot of circumstances out there like that where that is the case. And either that significantly draws down the price on the business, or it's just too much risk for a buyer to take on and they pass on the opportunity and the business ends up sitting on the market for too long. So customer concentration, ideally you want to keep that around 25% or less. And again, that just means you don't want any one customer or any one client of yours to be responsible for more than 25% of the overall revenue in one calendar year. So customer concentration, and then of course, messy financials, messy books, or inconsistency in your financials. Typically when you go to sell your business, everyone's going to be looking at the last 3 years of your financial performance. And you want to show consistency. Ideally you want to show growth over the last 3 years, but consistency, it's business, right? There's ups and downs. You just don't want to see major drawbacks one year and then swinging back up. Like, you want to be able to get a good sense of what does this business generate? Is there a consistent range that it generates or grows at? And so when there's huge swings, it is concerning for a buyer, it is concerning for a bank. And so those could be reasons why a buyer would pass on the business. And then of course messy books, not being able to see a true story in what's going on in the business by reading profit and loss statements, by reading tax returns. When things aren't categorized correctly, or they're moved around in different sections of the P&L, or they're not matching the tax returns, it just raises more concerns for the buyer. Because when you're looking at the financials and a buyer's uncovering some things and addressing it with the seller, it just it causes more concern for the buyer, and they'll start to question, what other surprises could I potentially stumble upon after I buy the business? Is there going to be something that I didn't see while reviewing the business, or the seller didn't even know about it while reviewing the business? And so messy books, messy financials, inconsistent revenue, and again, it doesn't have to be perfectly 10% growth year over year over year, but you want it somewhat consistent, and ebbs and flows is very normal in business, and so that's fine, but no major swings, clean books as best as you can. But again, those are another major reasons, right? High risk factors for a buyer, because what buyers are ultimately trying to figure out. I think a lot of people think it's always focused around the numbers, and of course, the decision is usually based around the numbers, but how easily can this business be transferred over to a buyer without those numbers having to change or move much, right? Without them being affected that much. And so that's what they're trying to analyze after reviewing the numbers. The numbers are the numbers, right? They're going to tell the story. There's really no getting around or bending those numbers as much as you can, because they're going to do their audits on the numbers. But what they're trying to figure out is, if I plug myself into this situation, will those numbers continue to do what they're doing? And that's when things like owner dependency, obviously price expectation, customer concentration, things like that can be perceived risk if customer concentration is too high, or the price expectation is too high, or the owner dependency is too high. So those are really, from my end, from selling businesses, are typically the major reasons why a business doesn't sell. And so the statistic out there of 70% of businesses that are actively trying to sell do not sell is very accurate, and in my opinion, I do think it can be prevented with proper exit planning a year, 2 years, 3 years in advance before you do go and sell. Because fixing something as small as owner dependency, or reducing that customer concentration to 25% as much as you can, really can be the difference between selling your business or not. You can have all the profit in the world, but you're the one generating it, or one customer is bringing it all in, and you just won't sell, even if it's profitable. And so these things can be fixed. Proper exit planning can make a world of a difference in the sale price and your ability to sell.